Hello, everybody. Thanks for joining us today to talk about company cars. It's our update on company cars. Let's see where this takes us. We've changed the format just slightly for today's webinar to see how this goes. Ordinarily, we sometimes do this as a little bit of a networking session as well. We've changed the format today. So it's me going to give a presentation on company cars. Nobody else is going to give any introductions today. And then we're going to move to a Q&A session at the end of today's presentation for any questions that you have that you want to ask and hear the answers to as a group. But I think everybody signed up knows me. I'm Linda. I run Coalesco. I tend to do the tax here. The team around me support in other areas in terms of accounts, VAT, payroll, etc. Appreciate this covers into payroll as well. But we're going to look at this with a little bit of a tax hat on today rather than anything else. So you have me. So sit back, have a cup of tea or coffee. Maybe you've got your lunch as well with you today. And we'll talk about company cars and a few other bits and pieces relating to company cars as we go. And as I say, we'll open up Q&A using the Zoom functionality. And we've got a Q&A section at the end of today's presentation. But you can ask me anything you like outside of this as well. We'll see how quiet you are or what we cover off. So today we're looking at company cars, which obviously mainly affects the limited company. We're considering this from a provision of cars to the employee point of view, from the employer's point of view, and also from our own point of view, as many of us today are our own director shareholders. So what are we talking about when we talk about a company car? Well, in absolute basic terms, a company car is an asset owned by the limited company or leased by the company and provided to the employee or the director. We, back in the 90s, often seen, or very, very often seen, company cars provided as part of a benefits package to an employee. It was an incentivization. It was the norm to have a company car. And that's certainly changed over the years. We really have seen companies move away from providing company cars. But there are certain company cars that work. And as we start to think about corporation tax, dividend tax, then quite often it's a good thing or a beneficial thing for the director themselves to really consider the company car, all depending on the type of company car that they want to drive, as we'll see more of as we go. If we drive a company car, there are tax implications for ourselves as an individual, and there are also additional costs from the employer's point of view of providing that company car. So when we think about the package that we're offering an employee or what the true cost is, if us ourselves as directors take that company car, we really need to be calculating and looking at this on a case-by-case basis. But we're going to look at some examples as we go. We're also going to cover off how these vehicles are taxed and what reporting requirements we have as an employer if we provide the company car to the individual. When we talk about company cars, we also always need to think about the provision of fuel as well. So we're going to cover that today too. So, company car. Metal four wheels provided by the company to the employee or to the director. It's a benefit in kind. So no different to having our gym membership or our PMI. It's taxable. It's a benefit of employment. We don't just have to provide the company car. We can also consider salary sacrifice, so reducing the gross pay of an employee and providing them with a company car instead. A company car is when we allocate that car to an individual and they can use it for private use and for business use purposes. That differs to what we sometimes have a discussion about in terms of pool cars. So a pool car is maybe a car that's owned by the company and it's available to a number of different employees for business use only. So if we take a letting agent or an estate agent as an example, they may have a pool of cars sitting outside their office, go back to their office each evening, and those cars are driven by a number of different employees to go and visit properties to either to undertake inspections or to do viewings of those properties with potential tenants. They are pool cars. They're cars that sit at the business premises, and the only mileage that goes onto those cars is for business use. They are not a company car, and they're not a benefit in kind for the purposes of today's discussion. We also might have a salesperson within our business who's covering 50,000 miles a year, but he only lives just around the corner from the office, and he doesn't want to put any private use mileage onto their car. And as such, he goes and parks it back at the business premises each evening. Again, that is not a company car when it comes to a benefit in kind. That is a pool car owned by the company, used for business use only. We are looking at this as I said, company cars are owned as an asset by the company or they're leased by the company and provided to the employee. If we have our private car that we're using within our business, remember that is not a company car. That's your personal asset that you continue to use, and the company reimburses you for the use of that car. Remember, however, if you've got as an example that salesperson that we just touched on who's doing 50,000 miles a year, if we're following the fixed profit car scheme allowance, that'll be costing you as the employer £14,500 a year in mileage claims to support his business mileage that he's undertaking for you in his private car. That is an instance where you may actually want to be providing a company car to that individual as part of their package because it's actually less costly for the company than him running his own car. So you can start to see those examples there and why every case is quite individual when it comes to company cars, and why this is one of the tax planning points that we always need to be considering for both yourself as the director, the company, or the employee that you're looking to provide a company car to. Are company cars taxable? Of course they are. Everything's taxable nowadays here, isn't it, in the UK? Gee. So the tax status of the company car does depend on its use, but we are covering off company cars that we're assuming there is a private use of that vehicle. That is a company car. So we're providing a company car to someone that's for personal use, and that does include commuting to work. That is taxable. So how much tax they pay depends on the value of the car, and that's the list price of the car plus accessories, and that is the original list price. So if you bought a car that's 3 years old, we still default the original list price of the car. The other part of how much is taxable depends upon the fuel type of the car, and there are now 4 fuel types, basically: petrol, diesel, hybrid, or electric. And we all the time have to refer back to the CO2 emissions that the car produces. The taxable value can be reduced. Okay, now, one of the things that we can see here is if we have part-time use. We do have instances where we split a company car across 2 directors, as an example, who are husband and wife. So we take the company car, we say it's a benefit to both of those parties, and we split that company car, say 50-50. So each person pays tax on that company car, but at 50%. And that can start to be beneficial for things like higher rate tax, super rate tax, or factors such as the impact upon child benefit. We can also start to reduce the taxable value by considering if we only use the car for part of the year. And so we have a client who runs a very nice classic car through his company, but that is only on the road for 6 months of the year. The other 6 months of the year, that car is sawn. And therefore we make a declaration to HMRC that the car is in use for 6 months of the year, and he pays tax on that vehicle for use for 6 months of the year. It does have to be a 30-day window that you don't have to have access to the car. But again, it is a way of considering a company car and looking to reduce the tax thereon. The lower the CO2 emissions of the car, the more beneficial that car becomes, as we can start to see. But what's very important to understand is the amount of company car tax that we pay is the same whether we do 50,000 miles a year in that car, 1,000 miles are private use and 49,000 miles are business use, or vice versa. There is no way of apportioning the amount of private use we undertake in a company car to business use. If the company car is provided, we pay personal tax on it, even if we only do 1,000 miles a year for private use purposes. Okay, there are some instances where a car does not need to be reported, i.e. it's not taxable. As we say, where it's privately owned and the company is not reimbursing fuel for that vehicle, but instead being presented with a mileage log each week, month, quarter, year. Where a car is provided, such as my pool car example, so it is for business journeys only. There is also an exemption if the vehicle has been adapted for an employee with a disability. That's quite a specialised area. A pool car is something that's shared between employees and it is kept on site. Or anyone that's running as a sole trader rather than a limited company, if you loan a vehicle to a relative who works within the business, then that's not considered to be a reportable benefit. Wow, what a little twist there for us. Okay, so how much is it going to cost an employee or a director to have a company vehicle? Well, let's start building the picture here and consider the income tax payable on a company car. So the very basic math goes, the value of the car, remember that's the original list price of the car plus the accessories that you've had or were added to that vehicle. And we times that by a multiplier, so a benefit in kind rate, and that gives our taxable amount. Now, those benefit in kind rates currently range between 2 percentage points and 37 percentage points. That's quite a window, isn't it, when we're considering what car we want to drive. And then we pay tax on the taxable amount that we've calculated above, and we pay that on our income tax band. So we can pay tax at 0%, 20%, 40%, or 45%, just in the same way as we do with any other income tax bandings. This is a basic mathematical example on the slide. We have a £20,000 list price car, very cheap in today's standards, isn't it? It's got a benefit in kind rate from that table of 20%, so it sits somewhere in the middle between 2 and 37%. That gives us a taxable value of £4,000. We assume a basic rate taxpayer in my example here, so we take the £4,000, it's taxed at 20%. So providing this company car to an employee or driving it ourselves as a director gives rise to an annual tax liability of £800. Okay, so this applies to directors, partners, sole traders, employees. So remember, everybody has a nil rate band up to £12,570. So if you have a spouse that we aren't paying a salary to, doesn't have any other source of income, a potential option to provide a company car to that person and that actually not be any tax to pay on the taxable amount. they can use their nil rate band for it. So maybe something to consider for a child going off to university. It's their first car, insurance rates are really high, they don't have any other source of income, or they have a job that earns them £5,000–6,000 a year. As long as that taxable value makes their total earnings less than £12,570, you could be providing them with a car through the company and them not paying any tax. Just want to spend a few more minutes looking at some real life company car examples and taking each of those 4 fuel types and starting to make you think about what that multiplier looks like in different categories. These are real cars. So the first example I want to talk about is a petrol car. It's a VW Golf 150 PS. The P11D value on that car at the moment is £27,990, so let's call it 28k. And the CO2 emissions that it emits is 127. And that means the multiplier there is 30%. We take 30% of £27,990, and that gives us a taxable amount of £8,397. So if that employee or myself as a director is a basic rate taxpayer, on that car, you pay £1,679 in tax per year, so £140 per month. Or as a higher rate taxpayer, obviously £280 per month. Does sound quite a lot of money. If we take the fuel type of diesel, we've got a few clients running Skoda Octavias. The P11D value on a Skoda Octavia is £37,525. The CO2 emissions are 121, so less than the petrol car. And because that's a diesel car, that falls into a multiplier of 29%. We again calculate the taxable value on that car. We're calculating that at £37,525 at 29%, which is £10,882. Say I'm a higher rate taxpayer, so I'm paying tax at 40% on the 10.8k. It's costing me £4,353 per annum in company car tax, so £363 per month. Not an insignificant amount of money. Now, obviously, there's been quite a push to move company cars to electric. So let's go to the other end of the spectrum and just look at those numbers if we're running an electric car. I have my Tesla Model Y. The P11D value is £59,935, so nearly 60k. CO2 emissions are 0. And so we pay a multiplier of just 2%. So we are literally taking £59,935. We're putting through a multiplier of 2%, and we're saying the taxable value of that car is £1,199. So even as a higher rate taxpayer, I'll be paying tax on that at 40%. So that's £480 per year. So yes, I really can provide myself or an employee as a higher rate taxpayer with a Tesla, a £60,000 car, and pay just £40 per month in tax on that. Electric cars aren't for everyone. We're just going to cover off electric cars in a little bit more detail, but let's think about example 4, a plug-in hybrid, the 4th fuel type. A Kia Sportage, again, quite a common hybrid car that we all see on the roads nowadays. P11D value of £40,520. CO2 emissions of 25. That gives us a multiplier of 8%. So I take my £40,520, I multiply that by 8%, and I'm paying tax at 20% or 40% on £3,242. So if I'm a basic rate taxpayer, I'm driving a hybrid car and I'm paying tax of £54 per month on that. And this is where we need to get to. As directors, most definitely, of our own limited companies, we need to start thinking about what the tax is on the car I would want to drive that was provided to me by the company. Because what's my alternative? I take a dividend. I take a dividend to afford a car. So I took an extreme this morning and I said, okay, if I want to drive my 70,000 pounds Range Rover, it's got 260 CO2 emissions. So the full multiplier of 37%. I've got a taxable amount there of £25,900. I'm a higher rate taxpayer by that stage. I'm going to be paying tax of £863 per month. But my company is paying for that vehicle. If I had that on hire purchase personally, and it was £1,800 per month, I'd need to be paying myself a dividend, paying the tax on it to net that £1,800. I'd need to be taking £2,700 from my company each month to be driving the Range Rover that I own personally, rather than paying personal tax of £863 a month on a company car that the company is providing to me. And that's why we talk about company cars still, because we always need to be thinking about what's the impact upon my company of having a company car, and what's the impact upon me, and how do I afford to drive that car personally if it's not provided for by the company? And if it means taking significant dividends from the company, is the company car tax such a bad thing? I don't know. We always need to think about it. We need to think about it on a case-by-case basis. Let's go back to the company. Let's consider as the employer, by either to an employee, to your spouse, to yourself personally, what the additional costs are of providing a company car. Okay. And the employer has to pay Class 1A national insurance contributions on the taxable amount of the company car. So it's kind of like saying we've got a cash equivalent. We pay employers NIC on gross salaries payable. So if we provide that benefit in kind to an employee or ourselves, we have to pay 13.8%, the same way as we do on salary, on the taxable value. So on the example on the screens back there, we had £4,000 taxable value. The additional cost to the employer, to the company, in national insurance contributions of providing that company car is £552. Now, the company's got two options, hasn't it? It can buy the car either outright on HP, whatever it happens to be. If it's an asset, we can start to look at capital allowances. So we can start to reduce the taxable profits in the limited company by writing down the value of the car. We can also take the lease, or we can lease a car. So if we lease a vehicle, we have a monthly charge to the profit and loss account, and there's a deductible expense again in the calculation of profits that reduces the profits and reduces the corporation tax payable by the company. Remember, the employer is providing a fully expensed company car to the employee or to you as a director. So the company is paying all costs. It's paying insurance, it's paying road fund license, it's paying any repairs on that vehicle. If it's subject to an MOT, it's paying all of those costs. So as a director, we wouldn't need to be paying any of those expenses ourselves. They all become the liability of the company. Or if we're paying it for an employee, it is a fully expensed company car. That looks at the piece of metal and the four wheels, but obviously we need to power it. So we always need to think about the fuel as well when it comes to a company car. So we don't have to provide fuel with the company car. We can just provide the company car, or we can provide all fuel into that company car. If we provide all fuel into that company car, the employee or ourselves as directors pay an additional tax on the benefit in kind of having the fuel provided both for business and for private use of that car. But remember, we do not have to give fuel, or as the employee, we do not have to take fuel. And again, we need to do the maths all the time on a case-by-case basis and think about how many private miles we're undertaking in that car. We obviously don't want to be paying a fuel benefit in kind and paying the tax on something if we're doing a really teeny amount of personal use in this vehicle. So going back to my VW Golf example and the petrol car, the fuel benefit at the moment is £27,800. And we take the same multiplier as we do for the company car. So the multiplier was 30%. So £27,800 is fixed by the government for driving a fuel car. We take the £27,800, we multiply it by 30%, being the multiplier rate for that particular benefit in kind. And if I was a 20% taxpayer, I pay £1,668 in tax for having fuel provided for my company car. If I'm only doing 1,000 miles a year, and therefore I'm only paying, I'm only getting the benefit of £500 worth of fuel covered by my employer, I wouldn't want to be paying £1,668 in tax for that privilege, would I? So I'd start to be having a relationship with my employer where I was looking at having a fuel card and reimbursing for private use. And I have to reimburse for the private use of the fuel in my company car based on a rate that's predetermined every quarter by HMRC. But again, it's an option, and it all depends on personal circumstance and how much fuel I'm going to be using for private use as to whether I want to take that benefit in kind or not. So what happens with the electric vehicles? Well, electric vehicles have obviously become really common. It's the way forward. But it's kind of a misunderstood technology, and we don't really know where we're going. So as we saw in the example, when it came to the electric car, the multiplier was just 2%, and that's fixed through until at least 2025. Now, obviously, the autumn statement is the 30th of October, and we don't know how that's going to pan out for electric cars. Would I be buying an electric car before the 30th of October without understanding the rules? No, I most certainly wouldn't. But electric cars, as we saw, can be provided at a very minimal taxable cost to yourself as a director, family members if we wanted to, or employees. So how do we report all of this to HMRC? Well, we undertake the payroll administration for an employee or ourselves. We provide the company vehicle, and we tell HMRC using a form called P46 car. We tell HMRC what we're using, what we're driving, sorry, and the individual has a change to their PAYE code. So they pay tax as they go through their salary on payroll. From a company point of view, we complete a form called a P11D at the end of each fiscal year. And that's where we report how much Class 1A NIC we are going to owe. We can do various different things in terms of payrolling and payrolling that national insurance contributions rather than having an annual liability. But most of our clients go through the annual route, but that method will be changing. So we always need to think about, the pitfalls of having a company car. Well, trying to summarize where we've got to with all of the discussions and my ramblings today. The biggest thing that we notice is people get carried away when they choose their company car. It's really important when we've got a company car to consider the CO2 emissions and that original list price of the car. It's very easy to get carried away and we add something like metallic paint at a cost of £1,000. And believe you me, with a high multiplier, you soon pay a lot of tax for having a company car with metallic paint. CO2 emissions alter and change so much and have such an impact upon the multiplier. So again, we really need to think about what we want to be driving and how much it's going to cost us. You know, those tax liabilities we've looked at today vary so much, don't they? We need to make sure that we aren't putting the employee in the incorrect position when it comes to the provision of fuel. And we need to make sure that we're reporting all of this information. We also need to think about that we have the option to ask the employee if they want a better spec car than what we want them to be potentially driving, as to whether they need to make a personal contribution towards that car, either as a one-off at the start of having that car or a monthly contribution, as an example, that covers some element of private use. And that will start to reduce the taxable value for the employee and reduce that tax liability. Remember, the company car is a taxable benefit and it does have an impact on your child benefit. This is all linked to earnings. Remember, child benefits, we look at earnings now over £60,000 per year. And that includes the benefit in kind. So as we talked about splitting a vehicle 50-50 between husband and wife, we really need to, consider what that looks like and what impact it's going to have on any child benefit claims. Car allowances have become more popular, both for the employee and the employer. But we need to do the math to be fair with the employee. And as the employer, we need to think about what commitment we want to make. Do we really want to be signing up to that 48-month deal as an employer, having a lease car for an employee that may leave you after 2 years, and you either end up driving that car yourself, it's sitting in the corner of your workshop, or telling the employee that comes in to replace that individual that they have to drive a particular car might not always help with the recruitment of that individual. So I think the message always is, when it comes to company cars and from everything that we're seeing today, is we always have to seek advice in terms of our own personal circumstances, the company's situation, and the position that we're going to put an employee in. At the end of the day, company cars were seen as benefits, but they are now becoming something that is a little bit more of a costly tax liability in so many cases, and therefore always seek advice. Let's do the math together. Let's work out what that looks like for all parties involved and make sure it's a fair and affordable position for everybody. So to summarise, are company cars a worthwhile benefit? Well, 6 of one and a half a dozen of another, as I'll always say to you. So just to remember, we'll always have additional tax liabilities if we've given a genuine company car. But it eliminates the need for us to have a personal car. So just as my example with that Range Rover, where I'd need to be taking significant dividends to be paying the hire purchase payments myself, actually the tax liability doesn't feel that bad in comparison to the dividends that I'd need to be affording to take from the company. All of these expenses that we incur from a company point of view are deductible expenses in the calculations of corporation tax. So if we run a very successful company and we've hit corporation tax, levels of now 25%, again, maybe having that company car isn't such a bad option. We've talked about company cars today. There's always the option to have a company van. Company vans are taxed differently. It's a flat fee, regardless of what that company van looks like. And those, taxable amounts, aren't significant. With a company van at £3,960 a year and a company van fuel benefit at £757 a year, maybe we all need to be thinking, about that company van, given the type of business that we incur. So as I say, we always have to start thinking about every individual case for yourself as a director, what that means for the company, and what that means to an employee that we're looking at providing a particular car to, or giving them options, such as a car allowance, etc., and how that will pan out for all of us. Okay, that really is what I wanted to try and cover off with you today. It was a reiteration of information that we've shared before, both on seminars, but on one-to-one bases as well. It's really important that we do the math, and we always remember there are options to have company cars should circumstances change for the business, yourself personally. But we always need to think about how much that's going to cost us in tax. It's all about tax saving all of the time, isn't it? So I'm reliably informed that on Zoom, the question box is open. I'm going to stop sharing my slides now, and see if anybody has kindly dropped anything into my question and answer box. No, we haven't. Not a problem whatsoever. Either I've covered everything off really well, or nobody has anything to say. Oh, hang on. There you go. Somebody tells me that they have a question. Type away your question then. Go on. See if we're typing. Type your question, Richard. Oh, it's gone shy. I think he's going to potentially. Here we go. Right, let me have a read. Okay. So Richard's question basically is saying that he's running a company car, and he's been paying some of his expenses from his personal account instead of realizing that they were completely deductible expenses for the business. That's absolutely fine. No problems whatsoever. We can look to reimburse expenses that we've paid for personally from the limited company. So as an example, if you've been paying your insurance from the company account, sorry, from your personal account rather than the company account, there's no reason why we can't make an expense claim for the company. That's absolutely fine, Richard. No problems whatsoever. The other question that's come in is about having an electric port at home to charge an electric vehicle. That again is absolutely fine. That's a deductible expense for the company, and we can look to claim allowances for that. So we can reduce corporation tax by having an electric port at home. If it's a company car that we're charging, then we can look to reimburse you as an individual for having the EV charged at home. That's absolutely fine. If we've got business premises, we can look to put the electric charging point at the business premises for use. And the other question that I've been asked today, so we've missed part of the presentation. Is there a recording? Yes, today's presentation has been recorded. We'll be doing some work on the back of that. Okay, another question. So when we have an electric vehicle, so we've got a client here on this webinar with us today who has an electric vehicle. He hasn't been claiming any mileage for driving that vehicle. We can make mileage claims against the company for driving an electric vehicle. We have to keep a mileage log, and we can charge the company a rate per mile. And that rate per mile has been changing quite a lot with HMRC. HMRC publish rates each quarter. They do come out in monthly e-news. They're always on our website, so you can have that link always available when you're making those mileage claims. So it's been 4, 8 and 9 pence per mile. So we do need to be keeping our logs and keeping track of those mileage rates there. That one's for you, Ian. Okay. Okay. That finishes my open questions in the Q&A session. Some nice positive comments and some thanks. Thank you for joining me today. If there's anything that you don't want to ask in the Q&A box, that's absolutely fine with me. To always get in touch. You know what I'm like. I always answer every question, and we've got lots of things going on at Coalesco that are all positive and exciting. It's great to be back doing these webinars in my happy place, talking to you about what we can do to help you save tax. Thank you, everyone that joined me today. Thank you for your time. If you're watching the recording, again, if you've got any questions, please reach out. Take good care, everybody. Enjoy the rest of your lunch break if you've taken this as lunch, and look forward to seeing you soon. And as I say, anything can follow up, please do get in touch. I'll let you all disappear. Have a great afternoon. Thanks, everybody.